studying your last two. I swim med when they turned in. The staring down to mute. And can learn the pole that sunk he died.
In the previous sections, we learned that investment income earned by a corporation is taxed differently from active business income. Now let's take a closer look at the actual tax rates. One of the first things that surprises many students is that investment income earned by a Canadian corporation is subject to a much higher initial corporate tax rate than active business income. Active business income, when it qualifies for the small business deduction, is generally taxed at relatively low corporate tax rates. Depending on the jurisdiction and the applicable tax rules, this combined rate is often in the range of approximately 9 to 15%. Investment income, however, is treated very differently. Whether the corporation earns interest income, dividend income, rental income, or capital gains, the initial combined federal and provincial corporate tax rate is typically close to 50%. At first glance, this difference appears dramatic. Naturally, many people ask, why would the government tax investment income at such a high rate? The answer is that the government does not want corporations to become tax shelters for personal investments. If corporations could earn investment income at the same low tax rates available for active business income, business owners could simply leave their personal investments inside their corporations and defer paying personal tax for many years. To prevent this, the Canadian tax system applies a much higher initial tax rate to investment income earned by corporations. It is important to remember, however, that this high initial tax rate is not necessarily the corporation's final tax burden. As we will learn in the next sections, a portion of this tax is refundable when the corporation pays dividends to its shareholders. This refundable tax mechanism is an important part of Canada's tax integration system. For now, the key concept to remember is simple. Active business income generally benefits from lower corporate tax rates, while investment income is subject to a much higher initial corporate tax rate. Understanding this difference provides the foundation for learning the refundable tax system and the detailed calculations that follow later in this chapter. One of the most common questions in Canadian corporate taxation is, why is the tax rate on investment income so high? At first glance, it may seem unfair that a corporation pays close to 50% tax on investment income, while active business income can qualify for much lower tax rates. However, there is a very important reason behind this difference. Imagine two individuals with the same investment portfolio. The first person owns the investments personally and pays personal income tax on the investment income each year. Now imagine that the second person owns exactly the same investments, but instead of holding them personally, they place them inside a corporation. If the corporation were allowed to pay the same low tax rates that apply to active business income, the owner could leave the profits inside the corporation, continue investing them, and delay paying personal tax for many years. This would create a significant tax advantage simply because the investments were held through a corporation instead of personally. To prevent this type of tax deferral, the Canadian government applies a much higher initial corporate tax rate to investment income. This discourages corporations from becoming tax shelters for personal investments and helps maintain fairness across the tax system. But notice that the objective is not to punish corporations. The objective is to ensure that whether investment income is earned personally or through a corporation, the total amount of tax paid is approximately the same. This is the principle known as tax integration. When investment income is earned personally, the individual pays personal tax directly. When investment income is earned through a corporation, the corporation first pays a high amount of corporate tax. Later, when dividends are distributed, part of that corporate tax may be refunded. and the shareholder pays personal tax on the dividends received. Together, these two levels of taxation are designed to produce approximately the same overall tax result as earning the investment income personally. So, the high initial corporate tax rate is not the final destination, it is simply one step in a larger integration system. It exists to prevent unfair tax advantages, discourage tax deferral, and ensure that Canada's tax system remains fair regardless of how investment income is earned. When we hear that investment income earned by a corporation is taxed at nearly 50%, it may seem as though the government is simply collecting a very high amount of tax. But in reality, that initial tax is made up of several different components, each serving a specific purpose. Part of the tax consists of the regular federal corporate tax, which is paid to the Government of Canada. Another portion is the provincial corporate tax, which is paid to the province where the corporation is subject to tax. In addition to these regular taxes, there is also a refundable portion. This part of the tax is different because it is not necessarily permanent. Instead of being lost forever, it is tracked in special refundable tax accounts, such as the Refundable Dividend Tax on Hand, or RDTOH, and its related accounts. These accounts keep track of taxes that may later be refunded to the corporation. So, although the corporation initially pays a high amount of tax, not all of that tax represents its final tax liability. The process works like this. First, the corporation earns investment income. Next, it pays the high initial corporate tax. Then, the refundable portion of that tax is recorded in the appropriate refundable tax accounts. Later, when the corporation pays dividends to its shareholders, it may become entitled to receive a dividend refund, allowing it to recover part of the tax that was previously paid. At the same time, the shareholder pays personal tax on the dividends received. When we combine the corporate tax with the shareholder's personal tax, the overall result is designed to closely approximate the tax that would have been paid if the investment income had been earned personally from the beginning. This is why it is important not to focus only on the initial tax rate. The high tax paid at the corporate level is only the first step in a much larger integration system. A simple way to remember this is that the corporation pays a high initial tax. Part of that tax is refundable, and the final outcome depends on whether dividends are paid in the future. Understanding this big picture will make it much easier to follow the detailed calculations involving refundable tax accounts, dividend refunds, and tax integration in the chapters that follow.